You've never caused an accident, never gotten a ticket, 25 clean years behind the wheel, and this year, your car insurance went up anyway. Not for anything you did on the road. Because in one state, a driver with a spotless record and poor credit pays almost $3,700 a year, more than a driver with good credit, and a drunk driving conviction. There's a second score attached to your name. You've never seen it. You're not allowed to. And it quietly decides what you pay to drive, one credit tier at a time. Here's what almost nobody tells you. You have a credit score. You've seen it. Somewhere around 712, 680, 750. A number you can pull up on your phone in seconds. But there's a second one, built from the same credit file and used for something completely different. Your regular score predicts one thing. Will you pay back a loan? This second score predicts something else entirely. Will you file an insurance claim that costs the company money? It's called a credit-based insurance score, and it runs on a different scale. Your FICO tops out at 850. This one can run from 200 all the way to 997. A good number on one is not a good number on the other. It weighs your file differently too. Payment history, 40%. What you owe, 30. How long you've had credit, 15. Whether you've been shopping for more, 10. The mix, 5. Almost every auto insurer in America uses one, where the law allows it. Roughly 95%. And when they pull it, you never feel it. It's a soft check. It doesn't touch your credit. It doesn't show up anywhere you can see. So you drive carefully. You never file a claim. And a number you're not allowed to look at is quietly deciding your rate, priced by your number, not your driving. Meet Mike, 48, 25 years behind the wheel. Not one at-fault accident, not one ticket, not one claim. For years, Mike did everything right, paid his premium on time, shopped around once in a while. His rate barely moved. Then Mike lost his job. Not his fault. A layoff. The kind that hits a whole floor at once. The paycheck stopped. The bills didn't. A card he'd always paid in full started carrying a balance. One payment slipped. Then another. Mike's credit dropped. That part he expected. What he didn't know is that his insurance score dropped with it. Same clean record. Same car in the driveway, but that hidden number can fall 30, 40, 60 points in a single year, with nothing wrong on the road at all. Mike didn't notice. There's nothing to notice. Until the renewal notice arrived. His insurer had quietly re-pulled his credit, a soft check he never saw. And in a state like Kansas, a clean driver whose credit slipped from good to poor pays, on average, $1,300 more every year. $1,300. For a year, Mike spent unemployed. For an accident he never had. For a claim he never filed. He lost his job. And the system decided that made him a worse driver. It didn't. It just read his number. Priced by your number, not your driving. Mike isn't a special case. He's a rung on a ladder. And once you see the ladder, you can't unsee it. Consumer advocates ran the numbers on safe drivers. Clean records. The only thing changing is credit. Here's what they found. Take a driver with excellent credit and a spotless record. Now hold everything still. Same driver, same car, same clean history. And just lower the credit. Fair credit. The premium climbs. Poor credit. On average, across the country, that safe driver pays more than double. Not for anything they did, for a number. And where you live decides how hard it hits. In Florida, poor credit adds about 143%. In Minnesota, 172. In Michigan, before the state stepped in, 263%. A safe driver paying $2,600 on average just to meet the legal minimum. Pull back to the whole market. One recent analysis of 83 million quotes found the gap at its widest. A driver with exceptional credit paying about $1,600 a year, and a driver with very poor credit, same coverage, paying over $6,200. More than $4,500 a year. Same road, same rules, a different credit tier, priced by your number, not your driving. So here's the uncomfortable part. The insurers aren't making the number up, and that's exactly why it's so hard to stop. In 2007, the Federal Trade Commission studied this for Congress. Their finding was blunt. Credit-based insurance scores do predict claims. People with lower scores, on average, file more and more expensive claims. As a group, as a statistic. The industry leans on that. They'll tell you the score is just one factor among many. They'll point out that most people have decent credit, so most people pay a little less. But read the same report further, and the discomfort sets in. Those scores fall differently across different people. On average, Black and Hispanic drivers score lower, and so, on average, they pay more. The FTC tried to build a version of the score that predicted just as well without that gap. They couldn't. So the number works as a prediction. And at the same time, it charges the people with the least the most. And it compounds. A safe driver who can't afford the higher rate lets the policy lapse. Next time they shop, there's a penalty for that lapse too. In some states, hundreds of dollars, just for having been priced out once. It's a quiet sorting machine. It doesn't ask how you drive. It asks who you are and what kind of year you've had. Priced by your number, not your driving. Now the part they really don't advertise. You can't see the score, but you can move it. Because it runs mostly on your credit file. The same habits that lift one, lift the other. Pay on time. Keep balances low. Don't let old accounts close. Payment history is 40% of the whole thing. And here's the catch most people miss. Your insurer only rechecks on a schedule. Some pull your score at every renewal. Some only when you ask. So if your credit climbed back and your rate didn't, you may have to call and ask them to look again. There's one more thing buried in the rules. Almost every state that allows this also requires an exception for what they call extraordinary life circumstances. A job loss, a serious illness, a death in the family, a divorce. exactly what happened to Mike. But that exception isn't automatic. No one calls to offer it. You have to know it exists, ask for it, and prove it. Most people never hear the words. And 4 states decided the whole thing was unfair. California, Hawaii, Massachusetts, and Michigan don't let auto insurers price you on credit at all. In California, over 25 years, that one rule saved families more than $8,000 each. Everywhere else, the second score is still reading you, priced by your number, not your driving. Let's go back to where we started. A driver with a clean record and poor credit, paying more than a driver with good credit and a drunk driving conviction. Same roads. One of them has actually put people at risk. The other just had a hard year. It isn't that the number is a lie. It predicts. The data is real. It's that no one ever told you it existed. A second score, on a scale you've never seen, that you have no legal right to read, quietly setting the price of the one thing you need to get to work. Mike found out the way most people do, not from his insurer, from the bill. He didn't drive any differently. He didn't file a claim. He lost his job, and a number he couldn't see decided that made him riskier on the road. It didn't. It never does. So the next time your rate goes up and nothing about your driving changed, you'll know where to look. Not at the road. At the number they never showed you.